next guest thinks emerging technologies could create a major opportunity in the space. Blythe Masters is founding partner of Motive Partners, a specialist private equity firm investing in financial technology. Blythe, great to have you here. Welcome to the show.
Nice to be here. Thank you.
People think of fintech and they think of the names that have been crushed in the markets. Should we be concerned about these firms? Because the bear case will say these are just financial firms, and we should treat them accordingly. And if there's something bad that's going to happen in the economy, these firms will feel it even worse.
Well, the interesting thing about the fintech space is probably better labeled financial technology, because that really describes fully what it's all about. And it's much more than just some of the high-profile non-bank challenger actors that have been harshly treated, in some cases fairly so, in the markets. This is a gigantic space. The vertical represents almost $1 trillion a year of spend by financial services company on technology. It's also a horizontal because people are embedding financial technology in non-financial businesses in order to enable financial activity by their customers. That's approaching, over the next 5 years, another $1 trillion of spend. So this is a space that's too big to ignore. It's also one where technology-driven innovation is occurring at a furious pace. And that is something that will survive cyclical developments in interest rates and many other things. In fact, many of the companies in the space are not heavily leveraged and have business models that are relatively impervious to the ups and downs of rates, inflation, and other things that have affected more cyclical businesses. So there's still plenty of opportunity in this space.
Blythe, we spend a lot of time, like, Guy just mentioned it, thinking about unemployment rate and some of the trends and that we're seeing. And, today there was a headline like a PayPal, for instance, is cutting 9% of the workforce, 2,500 workers. Think about it. That's a company that has a really good balance sheet. It trades at a really decent valuation. The stock can't get out of its own way, right? So are we going to continue to see businesses like that really solve towards expenses, to your point, a little bit? And should we expect to see cuts in the space continue?
I think the issue you're referring to is bigger than the fintech space. I mean, we're looking at an environment where we've had a radical change of economic conditions, interest rates, inflation, and that has affected the cost of operating. We had a period where there was significant wage inflation. That has meant the cost of employing people rose. Significant increase now in interest rates, a refinancing wall that is being at least now alleviated somewhat by market expectations of future rate cuts, which has meant that the capital markets for debt have reopened somewhat. So those refinancings are getting done, good news, but they're getting done at extraordinarily higher cost. And the combination of the wage inflation, the higher cost of interest is what's causing layoffs in some of the larger economically sensitive businesses like a PayPal and many others. You mentioned others in your introduction. That is a phenomenon that is a cyclical phenomenon. It's not really about where the value creation in financial technology is coming from for the next few years, which is really much more about technological innovation and new technologies being deployed, notably AI and similar.
Blythe, you're absolutely in the Hall of Fame. You're a genius. And it's interesting. Oppenheimer was the movie of the year, I guess, last year. And we have the Big Short guys coming on in a few minutes. And think about this. I think The Guardian did an interview with you in 2008. But in looking back at credit default swaps back in the day, I mean, you were sort of at the forefront. What are your feelings about that today? I mean, I know you created them with the best of intentions, but obviously they was used in somewhat nefarious ways. Thoughts on that?
Gosh, well, that's dialing the clock back a bit. First of all, it would be actually nice to be able to claim that I invented credit derivatives. It's not technically accurate. I did help evolve them from an idea to a widely used instrument. Neither I nor JP Morgan ever had the idea of applying them to subprime home equity, loans or securities, and therein was the problem. In fact, we were deploying the contracts more as risk management tools, ironically. I think at the end of the day, the issue is not about the product itself so much as the way it was used.
Exactly.
And obviously the lessons were learned about the potential for derivatives to create contagion. And much of that was addressed in the financial reforms that occurred in the aftermath of the financial crisis.